Show me the money. That's what Jerry Maguire said, right? And that's exactly what these dividend stocks have been doing lately. I just wrapped up reading through Morningstar's latest report from August 4th about the top-performing dividend stocks. And holy smokes, July was absolutely bonkers for dividend investors. Like, we're talking about gains that make growth stocks jealous while still paying you to hold them. That's the dream combo right there. I remember back in 2022 when everyone was crying about their tech stocks getting obliterated. Meanwhile, dividend investors were just sitting there, collecting their quarterly checks, sipping coffee. Well, guess who's laughing now? These dividend stocks are crushing it on both fronts, capital appreciation and income. Before we dive in though, quick disclaimer. This isn't financial advice, I'm just a guy who gets way too excited about spreadsheets and yield calculation. So let's get into these 4 absolute beasts that top the charts: Invesco, AES, Travel and Leisure, and Comerica. And what's wild is that these aren't your typical dividend aristocrats that everyone's grandpa owns. These are companies that are actually, doing stuff, growing, making moves, not just sitting there like some utility stock from 1987 that hasn't changed its business model since Reagan was president. When was the last time you saw a dividend stock jump 33% in a single month? Because that's exactly what Invesco did in July. 33%. That's not a typo. Actually, wait, let me double check that. Yep. 33.23% to be exact. And over the past 12 months, we're looking at 26.51% gains. For an asset manager, these guys aren't Tesla or some hot AI startup. They're managing money, boring old money management, and they're up 33% in a month. The stock's sitting at about $20.61 to $20.81 right now, which, okay, that might not sound like much compared to your Nvidias and your Apples, but here's the thing. They're paying out 84 cents annually per share. That's roughly a 4% yield, somewhere between 3.97 and 4.1, depending on where you're buying. 4%. Do you know what your savings account is paying? Probably still like 0.5 if you're lucky. What I find absolutely fascinating about Invesco is they've got this whole global dividend sustainability portfolio product, which is kind of meta when you think about it. A dividend-paying company that specializes in finding other sustainable dividend companies. It's like Inception, but for dividends. They manage both retail and institutional money, about 67% retail and 33% institutional if we're getting specific, which means they're not entirely dependent on one type of client. That diversification matters, especially when institutional money can be flighty. The retail side gives them stability, the institutional side gives them scale. And get this, some analysts just initiated coverage with pretty optimistic price targets. We're not talking about Joe's Stock Tips blog here. We're talking legitimate analysts who think there's still upside from current levels. The quarterly dividend has been consistent too, which in this market is like finding a unicorn. Actually, no, it's better than a unicorn because unicorns don't pay you quarterly distributions. Now, AES, oh man, where do I even start with AES? This one's interesting because it's trading at just $13.12 to $13.20, making it super accessible for smaller investors who don't want to drop thousands on a single position. And get this. They're yielding over 5%, actually between 5.32% and 5.48% depending on where you look. That's proper income territory right there. 5.5%. In this market, when treasury bonds are bouncing around and everyone's confused about where rates are going, here's AES just casually throwing off 5.5% yield like it's nothing. But here's where it gets really interesting. They've been raising their dividend consistently. 5 increases over the last 5 years with an average bump of 4.63% annually. Let me put that in perspective. If inflation is running at 3% and your dividend is growing at 4.63%, you're actually getting richer in real terms every single year just by holding the stock. That's before any capital appreciation. Their Q2 earnings came in at 51 cents per share, up from 38 cents last year. That's not just growth, that's acceleration. We're talking about a 34% increase in operating earnings year over year. For a utility company, well, actually calling them just a utility company is selling them short. They're transforming into this sustainable energy powerhouse. They're not just maintaining old coal plants anymore, they're building the future of energy infrastructure. Solar, wind, battery storage, all that sexy stuff that gets the ESG investors excited. But unlike some of these speculative clean energy plays that don't make any money, AES is profitable right now. They're paying dividends right now. That 70 cents annual dividend per share, that's real money hitting your account every quarter. And with that kind of earnings growth, I wouldn't be surprised if we see another dividend increase announcement soon. The payout ratio is sustainable, the business is growing, and they're positioned perfectly for the energy transition. What's not to like? Okay, maybe the stock price seems low at 13 bucks, but that's what makes it accessible. You can build a meaningful position without breaking the bank. Travel plus leisure at around $58 to $59. Now this is where things get really juicy, and I mean really juicy. We all know travel got absolutely demolished during 2020-2021, right? I mean, this sector was basically left for dead, but here's TNL posting a 14.80% gain in July alone and 33.15% over the past year. 33% for a travel company. After everything this industry has been through, they're paying out $2.24 annually, giving you roughly a 3.77% to 3.96% yield, and that quarterly dividend of 56 cents has been steady as a rock. But here's what really caught my eye. Their payout ratio is only around 34.5% to 38.62%. That's insanely conservative. Most companies are pushing 60-70% payouts, desperately trying to keep investors happy, but these guys are keeping most of their earnings to reinvest in the business while still rewarding shareholders. It's like they're playing chess while everyone else is playing checkers. They've got a 10% dividend CAGR over the last 3 years too, 10% compound annual growth. Your dividend is literally growing by double digits while you sleep. The revenge travel trend is real, and TNL is surfing that wave perfectly. Think about it. Everyone was cooped up for 2 years, and now people are traveling like there's no tomorrow. Business travel is coming back, leisure travel is through the roof, and travel plus leisure is sitting right in the middle of all of it, collecting fees and growing their dividend. The company's confidence is what really gets me. They just declared another dividend, same as before, no cuts, no drama, just here's your money, thanks for being a shareholder. That's the kind of boring reliability that makes millionaires over time. And at $58.59 per share, you're not even paying a crazy premium for this growth. The valuation is reasonable, the yield is solid, and the growth runway is massive. How many people still haven't taken that post-pandemic dream vacation? Millions. That's future revenue for TNL right there. Comerica, the regional bank that everyone forgot about until they didn't. Trading at $66.61 to $66.86, yielding about 4.26% to 4.3%. Now I know what you're thinking. Regional banks? After everything that happened with SVB and First Republic? Are you insane? But hear me out. CMA gained 13.28% in July and climbed 28.46% over the year. They're paying 71 cents quarterly, which annualizes to $2.84, and they've been paying dividends since, well, basically forever. The thing about Comerica is they're not trying to be JP Morgan or Bank of America. They know what they are, a solid regional bank serving Texas, California, and Michigan. They're not over-leveraged, they're not chasing crypto or whatever the latest banking fad is. They're just banking. Boring, profitable banking. Their 3-year dividend growth is only about 1%, sure, but when you're already yielding over 4%, do you really need massive dividend growth? Sometimes consistency matters more than flashy increases. And with interest rates where they are, regional banks like Comerica are actually in a sweet spot. Their net interest margins are expanding. That's the difference between what they pay depositors and what they charge borrowers. It's literally their bread and butter. And right now, that spread is looking pretty tasty. They don't have the same commercial real estate exposure that's plaguing some of the bigger players. They've got a diversified loan book, and they're not trying to be everything to everyone. Sometimes in investing, boring is beautiful. And at $66 per share with a 4.3% yield, that's the kind of boring I can get behind. Plus, think about this. If we do get rate cuts like everyone's expecting, bank stocks typically do pretty well in that environment. You're basically getting paid 4.3% to wait and see if that thesis plays out. Look, here's my broader take on all this. And I've been watching dividend stocks for longer than I care to admit. We're in this weird moment where income investing is actually exciting again. For years, it was all about growth, 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 Tesla this, crypto that, meme stocks, whatever. But suddenly, getting paid 4 to 5% to own a stock that's also appreciating 20 to 30% annually, that's the sweet spot nobody talks about enough. These aren't your father's widow and orphan stocks anymore. These are dynamic companies that happen to pay dividends. What really gets me is that all 4 of these companies are in completely different sectors: asset management, energy, travel, and banking. That's not a coincidence. It tells me that dividend investing isn't just about buying utilities and REITs anymore. The whole landscape has shifted. Quality companies across all sectors are returning cash to shareholders because, and here's the key, they're generating so much cash, they don't know what else to do with it. That's a high-quality problem to have. And with Morningstar tracking these as top performers, when was the last time dividend stocks led the pack in monthly performance? Usually they're the tortoises in the race, slow and steady, but July 2025, they were straight-up hares. The sustainability metrics are what really seal it for me, though. None of these companies are stretching themselves thin to pay dividends. They've got the cash flow, the earnings, the whole 9 yards. That's not always the case. I've seen plenty of companies basically borrowing money to maintain their dividend, just to keep investors happy, desperately trying to maintain their aristocrat status even when the business is struggling. These four, they're generating real profits and sharing them. Old school capitalism, but it works. Makes you wonder if we're seeing a broader rotation back to quality, doesn't it? After all the SPAC nonsense, the crypto implosions, the meme stock madness, maybe investors are remembering that owning pieces of profitable businesses that share their profits with you is actually a pretty good deal. Or maybe I'm just getting old and conservative, but you know what? My portfolio is not complaining about those July returns, and neither is my dividend income. At the end of the day, getting paid to own stocks that are also going up in value, that's not revolutionary, it's not sexy, it's not going to make you rich overnight, but it might just make you wealthy over time. And isn't that what we're all really after? So if you found this analysis helpful and want more coverage of emerging dividend stocks and technology companies, make sure to hit that like button and subscribe to the channel. But remember, everything I've shared here is just my opinion and analysis. This is not financial advice. So always do your own research and never invest more than you can afford to lose. See you in the next one.